Hey there folks, here is our question today. How do we navigate the complexities of today's economic landscape? I'm Aaron Young. Investment Insight starts right now. It is so great to have you with us here on Ticker, and welcome to Investment Insights, presented by The Investor's Way, where each episode we dive into the world of wealth creation and provide practical tips on just how you can try and master your money. Now, with rising living costs, interest rates, of course, and inflation affecting investor confidence, and it's what everyone's talking about, right? Today, we're going to explore how these economic factors can impact investment decisions. Should we actually listen to them, or is there something else we need to pay attention to? Andrew Woodward from The Investor's Way joins us here. So good to see you. We watch the news, I read the news, and we are constantly seeing so much bad news, which leads people to think, maybe I'll just wait.
Yeah, it's unfortunately the reality for so many potential investors, I'll call them, that with all the news coming out and the doom and gloom and the confusing nature of all of this information, we see people paralysed by fear. That leads to inaction, and the unfortunate result being that we get to retirement age and we just don't have the assets that we need to support the lifestyle we want.
And unfortunately, retirement is actually a lot closer than you think it will be, right? I'm in my early 40s, and you start to go, wow, I don't have all that time in the world that I thought I once did in my 20s and 30s. We are living in intense circumstances,
Absolutely.
Right? We have just survived a pandemic. We have, it feels like the global financial crisis wasn't that long ago, and yet the lessons learned from there are completely different to the ones that we're confronting today.
Yeah, they are, absolutely, and we've survived all those things, but at the same time, the key to success in long-term wealth creation is about overcoming all of these short-term impacts. And I often give the example, US market in particular, 17 times in the last 10 years, it's fallen by 5% or more, and yet it's up 234% in that time frame. And so there's so many people out there who put off investing because they're fearful of what might happen, and they're missing all of this growth.
It's so true. If you watch the 6 o'clock news, if there has been a major drop of the S&P or a major drop of the ASX, it makes the news.
Makes the news.
But if there's slow gains, it doesn't make the news.
Yeah.
So therefore, in your mind, you are thinking about the other day when you saw that things dropped. You didn't see that the next day they rebounded.
When I talk to my clients, that's all they tell me about the stock market. They are fearful of the stock market because it crashes all the time. And so I have to spend an enormous amount of time showing them graphically how the stock market actually performs. And the thing that I love about the stock market is it's actually just human beings. And it's human beings repeating past behaviours. And so we see that every single day with the stock market and how it fluctuates. And the flip side of that conversation is we're all massive property investors. We all love property, but we can't check that price every day or every 5 minutes like we can the stock market. So why are we so comfortable with property markets and not necessarily stock markets? It's just the access to information.
It's so interesting. And right now we've been waiting for good news. I think about how in 2020 we thought 2021 was going to be better. In 2021 we thought by the end of the year we'd all be back on planes flying overseas. It took a whole other year. And then obviously we got caught by inflation that no one saw coming. Even the Reserve Bank got caught on that one as well. Now there's a lot of talk about waiting for the positive news being that rates will start to be cut. Maybe not until next year in Australia, for example. Do you think that people are getting too caught up in the micro waiting as opposed to playing the long game?
Absolutely. The simple answer is yes. The long answer is that it's almost something that we're bred to understand that if we take in all this data, we'll be better informed. But unfortunately, all this data coming from all these different locations with all these different perspectives just leads to overwhelm and therefore inaction. So waiting is the biggest, cancer on growing your wealth, because waiting doesn't get you any further forward than you were. So like you described before, you're in your early 40s, then you become in your early 50s like me, and if you haven't taken action because you've been overwhelmed by all this noise, you're 10 years further down the track and you're no better off financially.
I think about the aviation industry, which I follow closely and have interviewed CEOs of airlines, and they tell me that they basically have it in their planning that every 5 years there is some sort of a crisis, a health crisis, an economic crisis, something that makes it really difficult for them to plan, and yet they still have to plan. They still have to have investors. They still have to buy aircraft that might take 5 years to arrive and then keep them for another 25 years. You still have to make investments.
Yeah, exactly right. And that's part of my methodology and mentality when it comes to growing wealth is about consistent action. And consistent action where you're actively adding to your investments on a regular basis, irrespective of what's happening in all this other noise of different financial metrics that are out there.
There will be people out there who listen to that and say, all right, that's all good and well, but how can I do that? How can I find a way to keep making these things if my circumstances change? Or could be a job, could be a partner, could be, I mean, we know that obviously the world is a tricky place. Yeah. How can you keep that consistency?
Yeah, look, that's a great point. Like, people have life.
Yeah.
And life does get in the way sometimes, but having a plan for your money where you know where that money's going every month and making sure a little bit of it goes aside for your future self. So if you can balance life...
So not save for a rainy day, but save for a brighter future.
That's it. And getting that consistent amount of money, whatever it might be, and that might fluctuate over time, but if you can get some money every month going into some form of investment or saving for a larger investment, over time, that consistent action gets you the results that you're looking for.
And it's also training yourself for consistency, even if it isn't consistently the same amount of money, I'd imagine. At least doing it consistently means that you know that every month, it's kind of like going for a run and saying, I really can't be bothered doing 10Ks today, but just going for the run is important, right? Just making sure that you are teaching yourself discipline, I suppose it is.
That's what it is. Success with money is about solid foundations. And one of those foundations is the discipline of investing every month, irrespective of what's going on in the financial markets, whether it's the stock market, the property market, the commodity market, it doesn't matter. If you're investing consistently, spreading your risk, then you'll get the results you want over the long term.
This must be such a fascinating time for you. I mean, the investor's way, investing can come in so many forms, right? You think about when times are tough, people flee to gold.
Yes.
When times are good, they look towards things like stocks. Most people, their biggest investment is probably going to be their house.
Yeah.
What do you find are the things that in this circumstance, in this situation, most of your clients, most of the advice you're giving, what's it focused on?
It's focused on having a spread.
Right.
So, like you said, most people's biggest investment is their family home. And then we want to go beyond that because that can't produce you an income.
No.
It's a cost as such. So to secure your retirement...
Well, I mean, unless you use Airbnb.
Well, of course. But if you want to grow assets that produce an income stream to support your lifestyle, you've got to go beyond the family home. And I'm very much about teaching people to have a spread of risk and return and liquidity.
What's the first place you would go then? So you have your house, may not own it, you may be paying it off, and you say, I don't just want to have all my eggs in the house basket. Where would you start to look, or is it dependent on the situation?
It's always dependent on situation, but for those people who are just getting started and they want to take a little dip in the investing world, then normally we do look at the stock market.
So blue chip?
Not necessarily blue chip individually. Low risk at the moment, exchange traded funds. More and more people are becoming familiar with ETFs, and it's a very low risk entry point to get broad exposure. That diversification that we hear about all the time gives you a little bit of diversification, the ability to understand the movements in the stock market and understand how you're going to react to those movements when you turn on the news and you hear that the market's dropped so dramatically that particular day. I always talk about those days as Boxing Day sales come early. And that's when we want to top up our investments if we have capacity and take advantage of the fact that the market has ups and downs. And if we can take advantage of some of those down days, fantastic. But we don't want to time the market, it's time in the market.
So do you believe that keeping the investments solid as opposed to pulling them out on fluctuations, right? So you look at Berkshire Hathaway, we think about Warren Buffett, he's selling down a lot at the moment, even this week. A few weeks ago it was Apple. People look towards him and say that is a sign that he must know something is coming. Do you think that that's the right way to approach your investments, or do you think that we have to say, well, we're not worth $200 billion and our situation's a little bit different?
Well, you took the words out of my mouth. We're not all $200 billion investors, and I had the fortune of being in the Berkshire Hathaway AGM earlier this year and hearing him speak live.
Wow.
And he got asked that question about why had he sold down Apple.
Yeah.
And he was very, I guess, cagey to an extent, but it was like, I'm not signalling anything. This is not me saying the market's going to crash. It's just the right time to me to take some money off the table.
Don't anyone else sell, but I will.
Yeah. But to come back to your original question, the more often we sell, the more the transactional costs impact our returns.
Exactly, yes.
And I'm very much about avoiding those transactional costs, and it's a whole different topic, but one of the reasons why women are better investors than men is because they don't transact as often.
Is that right?
Yeah.
Oh, wow, that's an interesting stat. There are a lot of news enthusiasts. I think about people who sit and they watch CNBC. They might watch Ticker every day, sit at their Bloomberg terminals, and they're looking for the micro ups and the micro downs. We hear about inflation numbers. We hear about the jobless numbers in Australia, in America, in the UK, the Bank of Japan. What are the data points that you pay attention to?
Look, I think there's so many that come out that they can get overwhelming. The one that I focus the most on is GDP. And GDP, gross domestic product, it's the expansion of the economy. So if the economy is growing, then everybody will, it's kind of like all rising boats will lift everybody up. And so rising waters lift everybody up. And so a rising GDP has the flow-on effect of suggesting that the economy is strong, that profits will therefore be growing, companies will be growing, share prices can grow, investments are being made, all those types of things. Then you get caught up in inflation and interest rates and all that type of stuff. But that just takes care of itself over time. If the economy is growing, everything's going to go reasonably well.
What are the traps that people are falling into at the moment? Is it waiting? Is it taking action too quickly? What do you think it is?
It's waiting. So waiting to time the market, because it's like all this fear. What if I just wait if I wait for that market to crash? And it happens all the time. The markets fall, and then they come back very quickly, and we've missed the boat, and we start all over again.
Andrew Wood, always appreciate your time. Thank you so much.
Thanks, Aaron.
All right. And of course, a quick reminder that the following of this program is for information purposes only. Always do your own research before making any financial decisions. And of course, to learn more about how you can master your money, please do visit theinvestorsway.com.au to speak with Andrew and the team. There's so much to discuss. You're watching Ticker. I'm Aaron Young. Thanks for your company.
You're watching Ticker. We'll have more in just a few minutes.